Before we get to some of the picks, I wonder, here we are, amazingly, with jabs being delivered. Do you think the vaccine itself is going to usher in a new chapter for value?
Well, I think one of the things being a value investor means is you predict that things get back to normal faster than most people are willing to expect that to happen. So if you look at a portfolio like the Oakmark fund, most of our holdings today benefit from things getting back to normal, kind of like they were in 2019. And I think once most of the population has had an opportunity to be vaccinated, we'll see a very rapid return to what we used to think of as normal.
And how long do you see that chapter lasting? Is this going to be a multi-year effort?
Well, I think by sometime in the second quarter, most of us will have had an opportunity to be vaccinated. And I would assume that we will never go back to kind of the pandemic lockdowns that we've had through most of this year.
Bill, to that point, the fact that we see major indexes trading at or near record highs right now, does that make sense to you? I mean, how much further can this go as we look to 2021?
Well, one of the reasons we don't try and market time at Oakmark is if you think about 2020, if you'd known all of this news ahead of time, I doubt very much you would have called the market correctly. But despite the market selling at over 20 times next year's earnings, there are still pockets in the market, especially names like the financials or some of the travel and leisure names, where stocks are still selling at single-digit multiples based on 2019 earnings, and we think they'll get back to those levels pretty quickly.
So in that space, I know you like Ally and Conoco. I mean, Ally has, doubled from the March low. When do we know when it's no longer a good value?
Well, both Ally and Capital One spoke last week at the Goldman Sachs Financial Conference. And Jeff Brown, the CEO of Ally, was talking about how in 2 to 3 years he thinks they should be able to earn a mid-teens return on their tangible equity. That equity should be over $40 a share within 2 years. If you earn 15% on that, that's a $6 earnings level. Ally stock bottomed at about 11 in March. It's currently trading just over 30. But if they can earn $6 2 years out at a 15% ROE, we think that deserves a mid-teens multiple. So there's still a lot of runway ahead of Ally stock to get to a level that would look fairly valued. And Capital One, the story is pretty similar. Also trading below tangible book. We think they're the low-cost provider of credit card services. They've invested more in technology than any of the other credit card operators have. And they're selling at a single-digit PE based on what they did earn in 2019 when they earned 15% on their common equity. And we think, by 2022, these companies should be past the charge-offs that have hurt this year's earnings and should be back to something like a normal level of earnings.
Shepard Smith here. Thanks for watching CNBC on YouTube.